toes this past week, you had and continue to have the continuing saga in Greece with fireworks of their own tomorrow. Tomorrow's Sunday, and they vote on a referendum that will, to a large extent, determine their fate as to whether or not they stay in the Eurozone. Stay tuned, because the markets could be affected by what we hear on the outcome tomorrow. But what does it all mean? After all, the idea of getting and obtaining information is to gain knowledge, and then when you gain that knowledge, you have to somehow analyze it. Analyze it to figure out what your next move is. Well, I still think that a prudent investor hold an above average amount of cash these days. And the reason being is the markets are trying to digest all this information. Now, I just brought up a few points that I think are major, but you also had, I heard coming in, that Iran is closer to signing a deal with their nuclear program with us here in the United States. So that's going to have ramifications in the market, or it could anyway. Also, so as the market tries to digest this, it kind of churns and backs and fills, and it wants to know: are we in a transitory period for our economy, or is the economy in the midst of a seismic shift? Specifically, what to make of the employment situation. After all, it's that assessment that gives the truest gauge on the health of our economy here, and in turn helps us to determine, to some extent anyway, the thinking of the Fed. And that's always important. What's happening, or what we need to know, what's going to happen with interest rates moving forward. When will a move be made, if one in fact is made? Currently, I can tell you the bias is toward raising them, and that happening as soon as September. But if you remember, I reported about a month or so ago, 2 months ago, that they were seriously considering June as the first time to raise the rates in, 5-6 years. But we have to really consider what the Fed is doing to really have, to really make a confident move in our portfolio. And since the Fed considers employment as a key element in their monetary policy, this point bears a bit more attention. And I'm not sure that they have enough evidence to nudge rates up. Now, follow me here. We all know another mandate, or if you don't know, another function of the Fed is to keep a close eye on inflation. And I've always said, if you do not have wage inflation, there is no need to be concerned about prices getting away from you. Inflation, which increasing interest rates heads off. That's what they do. They hike the interest rates to tame inflation. And if you believe, like I do, that employment and inflation tend to feed off one another, then you don't see inflation as a short or even intermediate problem. Yes, there are pockets in this country right now where certain states have increased the minimum wage above the federal level. California, for instance, went to $15. I was going to say $15 a share. Went to $15 an hour from the federal mandate of 10 and change. Well, that's a pretty big hit. That's good for the minimum wage workers. But I don't see that as a major stumbling block down the road for our economy, meaning it won't necessarily translate into higher prices because minimum wages are on the rise. Add to that fact that oil was down this past week under the $60 a barrel. I think it was 57 and change, 58, somewhere in that neighborhood. So the price at the pump is, I'm expecting to remain stable to heading even a little bit lower. No inflation worries in the energy space, at least not for now, which happens, by the way, to absorb a fair amount of our income. And healthcare spending is a third of a big part of what we spend, and the biggest majority of what we spend in this income is on our housing and food and supplies. So 1/3 of that is energy, and I don't see a problem there as far as inflation, higher prices all across the energy board. So I ask, why would the Fed raise rates under these conditions? One could answer